We've been watching the situation in Taiwan with Nancy Pelosi, and we've seen how the markets have reacted. I'm just curious, before we even get into the earnings picture, what you think of this sort of macro situation, clearly the anxiety, Mona, that people seem to be having about it.
Yeah, look, Andrew, this geopolitical tension has been a theme we've been really seeing all year that has been weighing on markets. Of course, started with the Russia-Ukraine crisis. That's really driven some economic issues as well in terms of oil, energy, food, grain prices. Now we're shifting our focus to China, and not only the Chinese lockdowns that we've been dealing with all year, we're now getting a little bit more of the geopolitical tension as well. And of course, the risk and the concern is that we have a Russia-Ukraine 2.0, something that's even more severe coming out of China. I think for now it's a tail risk. I do think the trip will not lead to any real economic disruption, but of course the rhetoric and the headlines start to intensify, and it's something we need to watch going forward.
Kristen, how concerned are you about that? And then how concerned are you about some of these earnings? It's been a bit of a mixed picture. You can pick your poison. You can look at one stock, one company that seems to be doing more than fine, and other companies that seem to be down in the dumps at this point.
Yeah, I think related to geopolitical tensions, I completely agree. It's one more thing that could create volatility. It's one more thing when we're looking at what could create additional inflationary pressures, additional supply chain constraints. And so it's something that the market is going to pay attention to. But I think short term, it's not a major risk. It is indeed a tail risk. I think everything right now that is driving markets is about earnings, right? So the rally that we've seen has actually been, even though to your point, some have missed, some have beaten. We're at a rate right now about 75% of the companies coming in above estimates. They were better than feared. And I think some of the data that a lot of people are paying attention to is as it relates to the health of the consumer. So consumer spending being 65% of GDP, what are earnings telling us about the health of consumer, how they're spending their money? And I think an area to pay attention to this week is not just the story about nominal sales. So nominal sales actually benefit from inflationary pressures, but actually looking at real unit sales and whether the consumer behavior is shifting in a more significant way. And they're pulling back on expenditures and focusing more on durable goods.
And therefore, but how long do you think that that's going to be the case? I mean, do you look at this as a temporary situation, or do you say to yourself, we could be living like this for years?
I mean, that is the $64,000 question, right? In terms of whether or not this is a transitory inflationary environment at this point in time, whether it's stickier, whether we're seeing some commodity prices roll over. And that's really the debate about whether or not the Fed can engineer a soft landing here, or whether or not we tip over into a recession. And so I think the thing to look at right now from a market's perspective, right? Looking at the market's perspective, some people are pointing to that pullback in commodity prices, the pullback in gasoline futures, but we still have shelter costs, right? That are a significant part of CPI that are going to weigh on the consumer and affect their spending patterns. And so this is about looking at markets like New York, where rents are up 30% year over year. That is going to influence spending behaviors and earnings. And so I think you need to, from a portfolio perspective, be prepared for both. This idea that we could just be in a slowing growth environment, or that we may actually tip over into a recession given the tightening that the Fed is going to continue to pursue.